So gold is absolutely on fire, right? Hitting all-time highs, and everybody wants in. But what if the way most people think about cashing in on gold is, well, just flat out wrong? Today, we're diving into a totally different playbook for investing in gold, one that a company called Triple Flag Precious Metals seems to have perfected. Let's dig in.
You know, when you think gold, your mind probably jumps to gold bars or maybe those huge mining companies digging it out of the ground. But what if that gut instinct to just buy shares in the miners is actually a flawed strategy, especially in the world we're living in right now?
And that brings us to this hidden problem with gold. See, even with prices blasting off to the moon, a lot of the traditional mining companies are getting squeezed by something that's quietly chewing up their profits. Okay, think about it like this. For a regular miner, when gold prices go up, great, but so does the cost of everything else. The diesel for their trucks, the steel for their equipment, the wages for their workers, it all gets more expensive. It's this inflationary vice grip that really puts a cap on how much they can make. But what if you could lock in your costs and then just let your revenue ride the gold wave all the way up? Now that would be a massive, massive advantage.
So what is the smarter way? Well, it's called the streaming and royalty model. And it's a business structure that is specifically designed to give you all the juicy upside of a gold boom without ever having to get your hands dirty. This quote just nails it. It's perfect. These companies aren't in the business of owning shovels and haul trucks. No, they're more like highly specialized banks for the entire mining industry. They don't dig the holes, they finance them.
Okay, so here's the nuts and bolts of how it works. Imagine there's a mining company that needs, say, $500 million to build out a new mine. A streaming company will come in and say, we'll give you that cash. In return, they get a contract that says they can buy maybe 10% of all the gold that mine ever produces, but at a deeply discounted price that's locked in for decades.
So it really breaks down into 3 simple steps. First, the streaming company writes the check. They provide the capital. Second, the miner does all the hard work, the exploring, the building, the operating. And finally, the streaming company just sits back and collects its percentage of the gold at that cheap, pre-agreed price. And here is the absolute killer part. As the market price of gold climbs higher and higher, their cost stays exactly the same. That means their profit margin just automatically gets fatter and fatter.
So let's actually see this model in action. And for that, we're going to look at our case study, Triple Flag Precious Metals, which trades under the ticker TFPM. They are a textbook example of just how powerful this business can be. Triple Flag has built this incredible global portfolio with over 200 different assets, but the real cash flow comes from about 15 core powerhouse mines. We're talking about huge, long-life operations like the North Parkes mine in Australia and this giant mine called Cerro Lindo down in Peru. Having this kind of diversification across the world with a bunch of different proven mining partners, well, that's how you de-risk the whole operation.
And the results, they really speak for themselves. In 2023, the company churned out around 115,000 gold equivalent ounces, which put them right at the tippy top of what they promised investors they'd do. And that awesome performance turned directly into record cash flow per share, which, let's be honest, is the number that really shows you how healthy a business is. It's just solid proof that the model is working.
Right, you just heard me say GOEs, or gold equivalent ounces. What on earth is that? It's really simple. It's just an easy way for us to talk about all the different metals they get, gold, silver, copper, you name it, and combine them into one unit. It's kind of like converting a bunch of different currencies into US dollars just to make it easier to compare.
So, the big question, does this smarter model actually lead to better returns for investors? Well, this chart paints a pretty clear picture. Over the last year, Triple Flag has just crushed the GDX, which is that big ETF that holds all the traditional mining stocks. It's a really stark visual of the difference between financing the gold and actually digging for it.
But hey, the story doesn't just end with what they're doing right now. There is a potential monster of a catalyst on the horizon here that the market might be totally sleeping on. Let's just call it the silicon factor.
See, through a really savvy acquisition, Triple Flag got their hands on a potentially game-changing asset. And the whole argument here is that investors have not fully woken up to just how big this thing could be.
It all boils down to this one little number, 1%. Triple Flag now owns a 1% net smelter return royalty on a project out in Nevada called Silicon. Now I know what you're thinking. 1%? That doesn't sound like much, but it's 1% of what could be the single biggest North American gold discovery in a generation. So what in the world is an NSR, or a net smelter return? Think of it as the absolute purest form of royalty.
It is a cut of the money right off the very top before the mining company even pays its own light bill. That makes it an incredibly valuable, super high margin way to get a piece of a mine's success.
And hey, you don't have to take my word for how big of a deal this is. The massive company that's actually operating the project, AngloGold Ashanti, they're calling it a Tier 1 asset. And get this, likely the most significant new gold district in North America. I mean, that is a huge statement coming from a major global player.
So how does this all play out? Well, Triple Flag got this deal done in 2023. The really important engineering studies are expected in 2026, which will give everyone a much clearer picture of the economics. And then, the mine could start ramping up production somewhere between 2027 and 2029. But here's the key for investors. The stock price will likely start to reflect that value as each of these milestones gets hit, long before the first ounce of gold is ever even poured.
Okay, so we've got a really powerful business model, and we've got this huge potential growth driver. But of course, every investment has two sides to the coin. So let's be fair and lay out the complete picture, the bull case versus the bear case.
So here's the cheat sheet. The bull case is pretty obvious. As gold prices rise, their margins just expand automatically. Pure profit. They also have a great track record of raising their dividend. The bear case? Well, you're paying up for this quality. It's not a cheap stock. And at the end of the day, they still depend on their mining partners to do a good job, and of course, they need the price of gold to stay hot.
Let's just dig into those risks a little more. First, valuation. Like I said, this isn't a bargain bin stock. You are paying a premium for a top-tier business. Second, operator risk. If a mine that they finance runs into technical problems or, has a strike, it's going to hit their bottom line. And finally, commodity risk. Let's be real. If the price of gold tanks, this stock is going down with it. It's got leverage to the upside, but that also means it has leverage to the downside.
So after all that, what is the final verdict? This quote just captures the whole thing perfectly. It's a sleep well at night stock because you have this incredibly stable, high-margin business model. But it also has that wake-up rich potential, thanks to that massive silicon royalty that's kind of hiding in plain sight in their portfolio.
And that really leaves us with one last big question to chew on. In an economy this uncertain, is a business that has fixed costs but revenue that's tied directly to a rising commodity, is that the ultimate hedge?